right out of the gate, looking at ServisFirst Bank shares, ticker SFBS, for Q2 2026, we have what looks like a massive absolute earnings beat.
Oh, absolutely. The numbers here are really striking right from the top.
Yeah, so net interest income came in at $155.6 million, and that drove total net income to $85.8 million. Diluted earnings per share hit 1.57 for the quarter.
Which is just a huge jump.
It really is. It's a 40% jump year over year from Q2 2025. And even if you adjust for one-time items, it's still a 30% increase. Now, I do need to clarify for you up front, our data stack today doesn't include Wall Street consensus estimates or post-market stock reactions. We are flying strictly on the raw financial data.
Right. We're just looking at the absolute fundamentals today. And in that absolute sense, a 40% EPS jump is, it's exceptional.
And as for guidance, they didn't actually attach a formal numerical table to this release, but the qualitative outlook from CEO Tom Broughton was, well, incredibly bullish. He noted positive momentum across basically all their markets and explicitly said their loan pipeline is at, quote, record levels.
Yeah, and that kind of commentary is exactly what you want to see backing up a 40% earnings jump. But, we should probably add some perspective here.
Right, because my first instinct when I see a 40% jump in mid-2026 is skepticism. Like, to get that kind of growth right now, a bank usually has to either take on massive credit risk or just spend a fortune buying new deposits, right?
Exactly. You are entirely right to be skeptical. The current macro environment is just brutal on the cost of funding for most regional banks. They're struggling with margin expansion and efficiency.
So how did ServisFirst pull this off without juicing the numbers with bad loans?
Well, they didn't buy expensive deposits, for one. What we're looking at here is a bank that's leveraging a pristine legacy deposit base that lets them expand their margins while, practically everyone else is getting actively squeezed.
Okay, let's unpack this margin story then, because if you want to understand how a bank is really thriving, you have to look under the hood at the net interest margin, or NIM.
Right, the core engine of the bank.
Yeah. And for anyone tracking the balance sheet, an NI is essentially the bank's version of a retailer's markup, right? It's the difference between what they pay you for your deposits and what they charge a borrower for a loan.
That's a great way to think about it. And their NI have expanded to 3.63% this quarter.
Which is up 10 basis points from Q1 and a massive 53 basis points year over year. But here's what I don't get. The dominant narrative right now is that banks are having to pay up aggressively higher yields just to keep depositors from moving cash into 5% treasuries.
Oh yeah, the flight to yield is a very real problem for most banks.
Right. So how on earth is ServisFirst expanding its markup so effectively in that environment?
The answer is buried in their cost of funding. And honestly, the numbers are a bit staggering when you put them next to the industry average. Their cost of interest-bearing deposits actually dropped this quarter.
Wait, it dropped?
Yeah, it fell to 2.80%. If you look back at Q2 of 2025, it was sitting at 3.33%. So they managed to shave 53 basis points off their deposit costs while everyone else was fighting tooth and nail just to keep them steady.
That is wild. And they didn't bleed depositors by dropping that rate.
Not at all. Total deposits actually grew by 5% year over year, hitting $14.55 billion.
Wow. And I'm seeing here that non-interest-bearing demand deposits, which is essentially free money for the bank, like standard business checking accounts, that bucket is sitting at nearly $3 billion.
Yeah, that specific free money bucket is up 13% from a year ago. Which is, it's the holy grail for a commercial bank right now.
It really is.
That's their secret sauce, the underlying quality of their liquidity. They are sitting on $1.46 billion in cash, which is about 8% of total assets. But if you want to know the real reason their margins are expanding so fast, there's one specific line you need to highlight.
Let me guess, it's the FHLB line.
Exactly. They have 0 FHLB advances and 0 brokered deposits.
Okay, let's stop right there. Because I see banks leaning heavily on the Federal Home Loan Bank, or FHLB, all the time. Explain for us why having 0 reliance on FHLB and 0 broker deposits is such a massive operational advantage right now.
Well, think about a bank's funding, like a regular business's cash flow. Organic deposits, so local business operating accounts, consumer checking, that's like a company's steady, predictable sales revenue.
Right, it's relatively cheap and highly stable.
Exactly. Broker deposits and FHLB advances, on the other hand, are wholesale funding sources. Relying on them is basically like a business running its daily operations on high-interest corporate credit cards because their standard cash flow dried up.
Ah, I see. Because when a bank can't attract enough local deposits to fund their loans, they have to go out to the open market. They essentially buy broker deposits, which demand the highest interest rates, since those people are purely chasing yield.
Yes, or they borrow from the FHLB, which is a standard backstop, but it's expensive. It's hot money.
And if you're relying on those corporate credit cards, your cost of funds skyrockets and your NIM collapses.
Precisely. And ServisFirst just doesn't need to touch that hot money. Their organic local deposit base is so robust, so sticky, that they completely dictate their own funding costs.
So they have this mountain of cheap, sticky cash. My immediate next question is, what are they actually doing with it? If you just sit on $1.4 billion in cash, you aren't making money. Are they struggling to find borrowers?
Far from it. They're deploying it at a blistering pace. If we shift to the asset side, loans grew by $533 million in just the second quarter.
That's a 15% annualized growth rate.
Yeah, it brings their total loan book to $14.48 billion. And crucially, the yield on those new loans is moving up.
Right. Total loan yields hit 6.23% this quarter, up from 6.18% in Q1. So when you do the math on that, funding a loan at 6.23% using deposits that only cost you 2.80%, that spread is incredibly lucrative.
It explains the 40% EPS jump perfectly.
Right.
But as analysts, we do have to be precise about that yield number. You can't just take that 6.23% entirely at face value for a future run rate.
Right. I noticed that too. There's a fascinating quirk in the report. 5 basis points of that yield increase didn't actually come from writing new, higher rate loans. It came from a $1.9 million interest recovery on a previously non-accruing credit relationship.
Yeah, the nice little windfall.
Exactly. So to translate that, a borrower who had stopped paying, forcing the bank to put the loan on non-accrual, suddenly got their act together and paid up. And ServisFirst got to recognize all that back interest in one lump sum.
Which is obviously a great outcome. But when you're projecting future earnings, you have to back that one-time payment out to see the normalized run rate.
True, but even without that 5 basis point pop, the core loan yield is holding remarkably steady. It shows they're not having to slash rates to win that 15% loan growth.
Exactly. They have real pricing power in commercial lending.
Okay, but growth doesn't happen in a vacuum. It doesn't come for free. And I was looking at the non-interest expense line, and I see a potential red flag.
The salary bump.
Yeah. Salary and benefit expenses rose 16.4% year over year. That's an additional $3.7 million out the door, bringing total salary costs to $26.3 million just for this quarter. My immediate instinct when a regional bank bumps salaries by double digits is bloat. Like, management got comfortable and started overpaying.
It's a fair concern. But what's fascinating here is how transparent management is about this exact number. It isn't passive expense creep at all. It's actually a highly calculated offensive investment.
Meaning what, exactly?
The release explicitly ties this jump to the full impact of their expansion into the Houston market.
Okay, but why does an expansion cause such a massive immediate spike in salary costs? I mean, when a bank expands to a new city, they don't just lease a building and wait for walk-ins. They usually go in and poach entire teams of commercial bankers from local rivals, right?
Exactly. You're buying the talent, but you aren't immediately getting their revenue. When you poach a top-tier team in Houston, you have to pay their premium salaries on day one. But those bankers can't just magically transfer a multi-million-dollar loan portfolio over on day two.
Right, because those loans are tied up in complex covenants at their old bank.
Yes. It takes several quarters, sometimes 12 to 18 months, for those loans to mature or for the clients to naturally transition over to ServisFirst.
So you're absorbing the massive upfront salary cost, fully anticipating a revenue lag. But how do we know they're managing that lag effectively? Like, I want proof this Houston bet isn't dragging down the entire operation.
To see the proof on that, you just need to look at CFO David Sparaccio's commentary, specifically on their efficiency ratio.
Ah, right. The efficiency ratio came in at 29.65%.
Which in modern banking is just exceptionally rare. The ratio simply measures how much it costs a bank to generate $1 of revenue.
Right.
So lower is better.
Right.
For most regional banks, around 50% is considered very good. ServisFirst is spending less than 30 cents to make a dollar.
That really puts the salary spike in perspective. They maintain a sub 30% efficiency ratio while simultaneously funding a major expensive expansion in Houston.
Yeah, it tells you their legacy operations in their other markets are incredibly lean. The salary increases are targeted investments, not administrative bloat, and they actually improved that ratio year over year. It was 33.46% in Q2 of 2025.
So they're getting more profitable even as they absorb expansion costs. Now let's shift to how they're protecting that profitability. Because while loans are the engine, smart analysis requires looking at non-interest income streams.
The fees inside investments that smooth out the volatility, right?
Exactly. Total non-interest income was $12.9 million this quarter. A year ago, it was practically nothing, just $421,000.
Now, we do have to be a little careful with that year-over-year comparison because it's heavily skewed. In Q2 of 2025, they took an $8.5 million loss on marketable securities that dragged the whole category down.
Fair point. But even if you strip that out and look at the adjusted numbers, non-interest income still grew from about $9 million to nearly $13 million. And here's where it gets really interesting for me. If you look at the breakdown, the bank-owned life insurance, or BOLI income, nearly doubled.
Yeah, from $2.1 million to $4.1 million.
Yeah. And I looked into this. It wasn't some happy accident with market returns. The bank intentionally went out and purchased $150 million in new BOLI contracts in Q3 of last year, and then bought another $25 million in Q2 of this year. Walk us through this, because taking out life insurance to boost quarterly revenue sounds, well, bizarre to an outsider.
It does sound strange, but it's a classic, highly sophisticated balance sheet maneuver. Basically, the bank purchases life insurance policies on a select group of highly compensated executives. The bank pays the premiums, and crucially, the bank is the beneficiary.
But they aren't waiting for people to pass away to make money off this, right?
Right, no. The benefit comes from the cash surrender value of the policies. Those policies are invested, they generate returns, and the earnings on that cash surrender value are entirely tax-free.
Oh, wow.
Yeah. So it connects it back to Houston. ServisFirst is aggressively hiring, pushing salary and benefit costs up. By layering in $175 million in new BOLI contracts, they're generating a guaranteed tax-free revenue stream specifically designed to offset those rising employee benefit costs.
Wait, so they're essentially using tax-advantaged returns from life insurance on their executives to pay for the cost of hiring new teams in Houston.
That's exactly what they're doing.
That is structurally brilliant. But I have to push back a little here. BOLI is an illiquid asset. You can't just sell a life insurance policy tomorrow if there is a sudden bank run. Does locking up $175 million tie up too much of their liquidity?
That is the exact right question. And yes, it is a risk for cash-strapped banks. But remember the first segment. ServisFirst has 8% of total assets sitting in cash and zero reliance on wholesale funding.
Ah, right. They have the cushion.
Exactly.
Oh.
Their liquidity is so strong they can easily afford to lock up capital in illiquid, high-yielding BOLI contracts to optimize taxes. They have the balance sheet to play the long game.
Makes sense. And BOLI wasn't the only lever they pulled for recurring revenue. Service charges on deposit accounts jumped 25% year over year, hitting $3.3 million. And management commentary tells us exactly how they did it. Back in July 2025, they quietly raised service charge rates on treasury management products.
And this is one of the most underappreciated revenue streams in commercial banking. Treasury management isn't just a basic checking account. It's the complex software infrastructure a mid-sized business uses to manage payroll, process wires, handle cash flow, prevent fraud.
It's the central nervous system of a commercial client's operation, which is why raising the fee is so smart. The psychology of treasury management is that it is exceptionally sticky, right?
Absolutely. The friction to change is massive. A business is not going to go through the operational nightmare of ripping out their payroll APIs and retraining their accounting staff on a new bank's software just because ServisFirst raised the monthly fee by a few percentage points.
It's the ultimate inelastic service. You raise rates on a product your clients literally cannot easily abandon, and you immediately create a highly reliable fee stream. And it perfectly complements the lending business without adding a single dollar of credit risk.
Which is exactly what you want when your loan book is growing 15% annualized. You need those steady, risk-free revenues acting as a counterbalance.
Okay, we've talked about the deposit strength, the Houston strategy, the fee increases. But to give a true objective analysis, we have to address the red flags. In a bank lending out $500 million in 3 months, the main risk is always credit quality. Are they being careful? If you look at the non-performing assets line, there's a very clear headwind.
Yeah, this is the most notable friction point in the whole report. Non-performing assets as a percentage of total assets more than doubled year over year, rising from 0.42% to 0.96%.
Right, and total non-accrual loans where the borrower has stopped making payments are sitting at nearly $170 million.
Yeah, and the earnings report doesn't hide behind vague macro language here. They explicitly blame this increase on a, quote, large real estate secured relationship.
And whenever you see large real estate secured relationship paired with a spike in non-performing assets, alarm bells should go off. The word relationship implies a single sponsor or developer with multiple large loans. If one project goes down, the contagion risk to the rest of their portfolio is huge. Should we hit the panic button here?
Well, if you connect this to how bank accounting actually works, hitting the panic button is premature. You have to separate non-performing assets from charge-offs.
Okay, break that down.
A non-performing asset is a loan where the borrower is late. A charge-off is an actual realized loss, where the bank finally admits the money is gone and writes it off.
Right, so a non-performing asset is a serious problem, but a charge-off is an actual financial loss today.
Precisely. And while non-performing assets jumped, annualized net charge-offs actually fell. They dropped to 0.11% for the second quarter, down from 0.25% in Q1.
So in raw dollar terms, on a $14.4 billion loan portfolio, they only suffered net charge-offs of $3.7 million for the entire quarter.
Exactly. On a portfolio that size, a $3.7 million loss is essentially a rounding error.
But that doesn't solve the problem of the $170 million sitting in non-accrual. If those borrowers eventually default, won't that massive loss hit the earnings eventually?
Not necessarily, because you have to look at how the bank has reserved for future losses. This is the allowance for credit losses, or ACL. Banks don't wait for a default to take the hit. They provision cash out of current earnings to build a reserve shield. And ServisFirst has aggressively built their ACL to $181.8 million.
Which is 1.26% of their total loans.
No.
Mechanically, what does that mean when you pit those reserves against the bad loans?
It means their allowance covers 107% of their current non-accrual loans. If every single borrower in default walked away tomorrow and the underlying real estate collateral was suddenly worth zero, which never happens, there's always recovery value.
Right.
But even in that doomsday scenario, they've already set aside enough cash to absorb the entire loss without it impacting future quarterly earnings.
In fact, they provisioned $11.4 million just this quarter to keep that reserve ratio strong. So yes, a large real estate relationship clearly went bad, but the risk appears entirely isolated, completely ring-fenced, and crucially over-reserved.
And we should note that non-owner occupied commercial real estate, universally considered the riskiest bucket right now, sits at $5.12 billion for them. It grew by nearly $400 million this quarter alone. The fact that they're managing that aggressive growth while keeping actual charge-offs down to 11 basis points speaks volumes about their underwriting discipline.
Which brings us to the ultimate tension in this report, and a thought I really want you to mull over as you digest these numbers. We have CEO Tom Broughton touting a record loan pipeline heading into the back half of 2026. Yet, we just saw a large real estate asset go non-performing. The ultimate test for ServisFirst is going to be whether they can convert that massive pipeline into performing loan growth without taking on more toxic real estate debt.
It's the classic banking dilemma. Growth is easy if you lower credit standards. Profitable, safe growth is incredibly hard. They have to underwrite perfectly to maintain that pristine 11 basis point charge-off rate. And they have to do it while fully integrating those expensive Houston teams and defending that legendary sub-30% efficiency ratio.
They clearly have the cheap organic deposits to support it and the BOLI and treasury fees to smooth out expenses. Now, it all comes down to execution in a very tough environment.
Absolutely.
But remember, this is just one piece of the broader earnings season puzzle. The data is coming fast, and the macro landscape is shifting daily. Make sure you follow the show for our daily earnings coverage so you can connect these macro trends to the micro data and stay ahead of the market.